This market feels heavy and it's overdue. You know, I've talked about volatility a few times, and I want to make a distinction here. When I talk about volatility, I'm not talking about VIX. I'm talking about the peak to trough decline in a market. And the last 19 months, you haven't had greater than a 5% decline in the S&P 500. Excuse me, numbers were slightly off there. The last 14 months. It's been 19 months since the S&P 500 hit its 200-day moving average. Now, you pointed out the NASDAQ numbers, Scott, and yes, the NASDAQ is starting to show technical signs of a full-on correction. I think the S&P 500 is not far behind. And one might say, like I do, well, okay, the value stocks are going to hold up, right? Energy is going to hold up because crude prices are high. Financials are going to hold up because interest rates are high. But when 30% of the S&P 500 is in the top 10 names, and those names are all tech or tech-like, you can't expect the S&P 500 to hold in there. So on Friday, I was on with you, and I said, I think you're going to get a full correction this quarter in the S&P 500. That is mainly because the Fed has really slowed down the amount of cash that they're putting into the system. So you can expect normal volatility, i.e. a 10% plus peak to trough decline in the S&P 500 this quarter.
And let's be honest, it's time, right, for us to go ahead and get a correction in the S&P. I hope that the institutions just pull the Band-Aid off and sell us off at least 10% on the S&P. That'll put us down between 15 and 18% on the NASDAQ most likely. And then what happens after that? We do a reversal. The institutions have been buying, and they'll run it right back up. Okay, so, you know, at least they'll present buying opportunities. We can get it over with and see what happens the rest of the year. Maybe get a little, you know, less volatility. Who knows? But, you know, I'm just, right now, this up and down, like today it was down 2% on the NASDAQ, and then it ended up flat for the day, which is kind of crazy. But don't forget, the Fed speaks tomorrow. And so, you know, when they're going to speak, then, you know, who knows what Jerome Powell's going to say. The markets tend to act kind of funny. But what really got my attention was the data that came out Friday and over the weekend about us, the consumers, right? And how it's going to affect the economy, how it's going to affect companies with their earnings and things like that. Because, you know, this year is going to be a very interesting year, not just for the stock market, but, you know, we are returning to some very bad habits once again that we were in pre-pandemic. And this is what's really going to put us at risk, honestly, for a recession, for earnings to be lower and stuff like that. And so, as you can see right here, consumer debt in U.S. surges by a record $40 billion, okay? And you can tell by the chart over here, total credit jumped by $40 billion from the prior month. And if you annualize that, that is an increase of 11%, and that is 20 billion more than what Bloomberg surveys actually were projecting, as you can see on the chart to the right there. And then you got revolving credit outstanding, which includes credit cards, climbed 19.8 billion, the largest increase on record. And the reason why this is a big deal, here's the personal savings rate in America. And you can see over here from 2000 and 2015, you get an idea of what it used to be percentage-wise. And then you see during the pandemic here, boom, checks started coming out, money started flowing in our accounts. People were saving like a madman. And then, of course, it went down, peaked back up. So we got more stimulus, more checks. The child tax credit was advanced to you early every month. And then look what it is now. It just fell off a cliff. It's actually lower than it was pre-pandemic. And of course, this is a big deal, guys, because, I mean, just think about it this way. Remember before the pandemic, the survey that said, you know, over half the country couldn't even pay a $500 emergency bill if it came up, you know, because they got basically no savings. So you can imagine if those people, we're talking about probably almost half the country, couldn't manage their money before the pandemic. Do you think they're going to be able to manage it now? You know, you can guarantee they blew through that stimulus checks and everything else they've gotten. It's probably gone, right? And so this is the worst time to be running up credit card debt and revolving debt because interest rates are going to start going up, right? And so that means we're going to get back to the same thing what happened before was where so many people in this country were just paying the interest on their credit cards. That's all they could afford to pay. And so what happens to the balances? They just keep going up and up until they eventually max out. So they don't have any more to spend, right? And what keeps the economy going, right? It's people that make, you know, basically, I don't know, 30,000 to 200,000 is the majority of the country. They just go in these grocery stores, Walmarts and everywhere else, and Amazons, and spend money. And most people do use the credit card, but now they're starting to run it up at a big rate. And of course, we just went through the holiday season. And of course, this is the worst time to do it because of interest rates, but also because of what else is happening? Inflation.
Where do you see inflation this year?
Well,
CPI.
Okay. Well, we have to look at different measures of CPI. CPI is at 6.8 right now, year over year. The one that's rolling off for last December is 0.2. So the way things are going, it seems pretty likely that we're going to get a 7 handle on the CPI soon. But the CPI, of course, is a strange construct. It's not calculated the same way as European CPI. If you use the European CPI methodology, our CPI right now would be at 7.8. So it's calculated a little bit differently. Also, there's this strange thing about shelter that's almost a third of our CPI. And shelter includes largely something called owner's equivalent rent. And owner's equivalent rent is not a real thing. It's not like you're going out there and measuring rents. What you're doing is asking people that don't rent out their house, if you did rent out your house, what do you think you'd rent it out for versus last year? As if a regular homeowner that doesn't rent out their house has any idea. I probably couldn't estimate what I could rent my property out for within 20%. I have no idea. I've never looked at it.
So there's your main problem with all of this. We measure inflation by trusting the government sources to provide us with the data. Most of the time, no.
But rent is not a real thing. It's not like you're going out there and measuring rents. What you're doing is asking people that don't rent out their house, if you did rent out your house, what do you think you'd rent it out for versus last year? As if a regular homeowner that doesn't rent out their house has any idea. I probably couldn't estimate what I could rent my property out for within 20%. I have no idea. I've never looked at it.
And so, yes, he is 100% right. I've been saying this, that yes, inflation is higher than what they're telling us. We all know it. We all feel it. And so this is like the worst time to be running up this debt. But on top of that, this year right here, most people are going to be shocked, okay? And the reason why they're going to be shocked is this right here. Because they're no longer going to be getting those monthly child tax credit payments. Around 35 million families lost that payment starting in December. And if we do the math on this, guys, let's just say you have one kid at $250, right? Just all those families just have one child and that's it, right? So that's $250 times 35 million families. That comes out to be $8.75 billion per month. And I'm just putting one kid in there. Most people have 2 or 3 children, okay? So I'm going on the low end of this. And then you take that and you multiply it by 6 because they did it for 6 months last year. And that ends up giving us $52,500,000,000 if I'm counting all those zeros correctly over that 6-month time frame, which will no longer be happening. And on top of that, number 2 here is where people are going to be shocked when they do their taxes. The money you received ahead of time will count against your normal tax refund. In some cases, you may actually owe money. And so for those who don't have any experience growing up poor or lower middle class, let me tell you, people, like, I remember many years, depend on that tax refund, right? That's how a lot of people save money because they're terrible at doing it on their own. So they let the government do it for them, and then they get it back. Well, this year is going to be shocking to a lot of people because they're going to probably owe money, most likely, right? Or get nothing back. And they really depend on that, especially to pay off the old credit cards from the holidays, right? Well, that's not going to happen. So that is more money that is not going to be out there in the economy, okay? And then on top of that, what else is going to be happening right after tax season? You're going to have student loan repayments starting back most likely in May for 41 million Americans, okay, if they do not postpone this again. And you can see right here, this is the average monthly payment if you happen to have this and you're waiting on this. An associate's degree's average is $333 a month, a bachelor's $448, a master's around $695, and that's the 3 main ones you need to worry about, especially the associate's and the bachelor's degree. And just for kicks too, since the majority of America rents, I mean, look at the rents. Look at how high the rents have gone over the last year. And so, it's not just about the Fed and the money they're taking out of the market, as a gentleman at the beginning, talked about. It's about this stuff right here. It's these other hundreds of billions of dollars that aren't going to be there that were there last year and in 2020, okay? And so you're going to hear about this on earnings calls and stuff. So it ain't just about costs going up. It's going to be less money coming in for people as well. And so, we'll see how it goes. I just want to let you know, put that out there. Hit the like, subscribe button if you got anything out of it. Really appreciate it. Tomorrow will be an interesting day when the Fed speaks. The market always acts kind of strange. So we will see, and we'll see if the gentleman was right in the beginning, and maybe the pain will be over after the first quarter, and we'll start moving back up, or maybe we'll just start moving back up tomorrow because he'll say, we're not going to lower the balance sheet at all. Maybe we'll do 2 rate hikes. You just don't know. Okay, so anyway, hope you guys have a good one, and I will see you later.